Hey, I'm Ryan, and this is the weekly wrap-up, where I walk through the big news and events in the world of investing. Alright, let's get into it. First up is US inflation. Oof, I was really hoping this would continue to cool off, but following a steep pullback in April, the May print released on Friday came in at 8.6% versus an estimate of 8.3%, and reaching a fresh new 40-year high. Just icky. Core CPI, which excludes food and energy, came in at plus 0.6% over the previous month versus expectations of plus 0.05%, which I guess isn't a disaster, but it shows you that this whole inflation thing isn't just because of oil. And man, that made for a messy start to trading, as this is how things looked after the market opened. With the S&P 500 projected to close down for another week, this would take the tally to 9 of the last 10 weeks. Oh, what a fun time to be a long-only investor. And for all their differences and funny languages, the EU finds itself in the same boat as the US, after inflation spiked at 8.1% in May. The European Central Bank, the ECB, has been under fire for not doing, well, anything, compared to J-Pow and the gang, which never really seems to shut up. The ECB, which last did any interest rate hike in 2011, has basically been sitting on their hands as inflation has been spiraling. Finally, and I'm assuming this is after someone checked that they were still alive, ECB President Christine Lagarde announced on June 9th that they're planning for a quarter-point hike in July and likely a half-point hike in September. A quarter-point hike next month? Look, I'm the first to bellyache about an overly hawkish Federal Reserve in an economic downturn, but really ECB, 8.1% inflation, and your magic solution is to only now lift deposit rates from negative 0.5% to negative 0.25%? I know the old world moves a bit slow, but good grief. Next, the oil price is going bananas again, tickling the highs it hit during the pop after the Russian field trip to the Ukraine kicked off. Cooling economic forecasts, i.e. lower expected demand, and the belief that OPEC and friends would lift some of the heavy burden helped the price retreat back below $100 a barrel. But lately, things have been popping off again. On May 30th, the EU announced it was planning on banning nearly all Russian oil imports by year's end. And normally, when the price gets out of whack, the Saudis try to play dumb, and the Central Bank of Oil just sits back and enjoys the fireworks. But after months of pressure from President Biden, on June 2nd, OPEC Plus agreed to boost output for July and August by 648,000 barrels per day, or 50% more than previously planned. Well, this sounds sweet, but apparently it rings a bit hollow. JP Morgan writes, with only a handful of OPEC Plus participants with spare capacity, we expect increase in OPEC Plus output to be only around 160,000 barrels per day in July. Sounds like a drop in the pond, really. Likely just as big a culprit is the hysterical lack of refining capacity in the US, which is reportedly 6% lower than it was 4 years ago. And you might say, oh gosh, that's unfortunate, but considering who owns the refineries, it's hard not to believe that refining capacity is being relaxed just to jack up petroleum prices. When people complain about gas prices, you can just sit back and blame it on the war and hope no one notices that you're having the best fiscal year in history. Yucky. The lumber price rocket ship seems to have re-entered orbit. Once a comical, albeit painful example of the state of the US housing market over the course of the pandemic, since peaking at $1,460 back in March, CME futures hit $563, down over 60%. The main reason for the decline is apprehension in the US housing market, which is up 42% since the start of the pandemic. And yep, there's been inventory increases, more houses on the market and on it for longer, with Zillow reporting that 83% of the US's 400 largest real estate markets are seeing inventory buildups from the record lows over the last 6-week reporting period. But still, inventories are shockingly reduced from where they were only 3 short years ago. The National Association of Realtors estimates that housing inventory currently sits at 1.03 million units, while Logan Mohitashi, lead analyst at HousingWire, estimates that from their models, this number needs to be between 1.5 to 1.9 million units in order to return to a more normalized, less stupid levels. I added the stupid part, he didn't say that. Is a slowing economy, de facto housing bubble, and a mortgage rate rising cycle enough to cool off the US housing market? Who knows? A pandemic couldn't do it. And US housing starts, usually a leading indicator of lumber prices, doesn't really seem to be fading. Anyway, at least you can afford to build that deck now. The Twitter saga continues, with Elon apparently doing anything he can to get out of paying another $39.4 billion for the rest of Twitter. Whether it's his inability to find additional co-investors given that the market has since tanked, The strain on his committed Tesla shares? I mean, he could, after all, end up getting margin called by his Tesla bankers if his Tesla stock collateral dips too low. Or maybe he just found a shiny new thing, who knows? Elon first tried to quash the deal by claiming that if bot numbers prove to be higher than the Twitter estimates of 5%, that's material enough for him to be able to walk away from the deal. But it's not. Things like this happen if you sign a non-binding deal and waive your rights to due diligence. And when you claim that you want to buy Twitter to fix the bot problem, you can't legally walk away after claiming that they have a bot problem. So his next tack is to try to claim that Twitter's management hasn't been forthcoming with data requests. Basically, ask for enough private information, and if they finally say nope, then you can go to a judge and be like, they're meanies, I don't want to buy them. The old fire hose approach. It's a low probability, but he has had his lawyers file a complaint with the SEC claiming that Twitter has in fact refused to provide information that Mr. Musk has repeatedly requested since May 9th, 2022 to facilitate his evaluation of spam and fake accounts on the company's platform, blah blah blah. Please cancel the deal. I don't love Elon, but I do find him entertaining. This, however, is just getting sad. Alright, speed round time. The former CEO of Google, Eric Schmidt, and PayPal co-founder and Bond villain inspiration Peter Thiel have co-founded a new non-profit venture capital fund named America's Frontier Fund and are petitioning the White House to contribute. The idea is that America is falling behind in the technology race, read as China, which could potentially damage the country's future economic prosperity, and it wants greater funding and collaboration across government and academia to develop technological areas of the future. The big focus seems to be on US semiconductors, where the momentum has, well, swung the other way. Kinda sounds like stuff DARPA's supposed to do, but I'm cool if it moves the needle towards US prosperity. And anyway, I can't disagree with Peter Thiel. That guy scares the heck out of me. Next, citing unnamed sources, the Wall Street Journal announced that Beijing's cybersecurity review of ride-hailing app Didi, basically Chinese Uber, will be coming to an end. Shares jumped 53% on the news. Recall that Didi got in hot water after listing its shares in the US without authorization of Beijing, and has since had its service pulled from the Chinese App Store and has been tied up in a punishing review process ever since. Logistics provider Full Truck Alliance and online recruitment platform Canshun have also popped double digits as they're expected to be cleared as well. The Chinese tech crackdown seems to be coming to an end. I made a video on this a few weeks ago and think there could be some great opportunities within Chinese tech.
Alright, so that's all I got for today. I hope you enjoyed it, and if you did, please give it a like and consider subscribing for more informative and hopefully entertaining financial content. I'm Ryan, and thanks for tuning into Market Lab.